Today, we will talk about expected return. Hi. Let's learn about expected return. The expected return is the profit or loss that an investor anticipates on an investment that has known historical rates of return. It is calculated by multiplying potential outcomes by the chances of them occurring and then totaling these results. Expected return calculations are a key piece of both business operations and financial theory. For example, if an investment has a 50% chance of gaining 20% and a 50% chance of losing 10%, the expected return would be 5%. The expected return is a tool used to determine whether an investment has a positive or negative average net outcome. It's calculated as the expected value of an investment given its potential returns in different scenarios. It's important to note that the expected return is usually based on historical data and is not guaranteed into the future, but it does often set reasonable expectations. When considering individual investments or portfolios, a more formal equation for the expected return of a financial investment is used. In essence, this formula states that the expected return in excess of the risk-free rate of return depends on the investment's beta, or relative volatility compared to the broader market. The expected return and standard deviation are two statistical measures that can be used to analyze a portfolio. To make investment decisions solely on expected return calculations can be quite naive and dangerous. Before making any investment decisions, one should always review the risk characteristics of investment opportunities to determine if the investments align with their portfolio goals. In addition to expected returns, investors should also consider the likelihood of that return. The expected return does not just apply to a single security or asset. It can also be expanded to analyze a portfolio containing many investments. If the expected return for each investment is known, the portfolio's overall expected return is a weighted average of the expected returns of its components. Expected return calculations are a key piece of both business operations and financial theory, and is a tool used to determine whether an investment has a positive or negative average net outcome. Historical returns are the past performance of a security or index, such as the S&P 500. Expected return and standard deviation are two statistical measures that can be used to analyze a portfolio. The expected return of a portfolio is the anticipated amount of returns that a portfolio may generate, making it the mean of the portfolio's possible return distribution. Expected return is an estimate of the average return that an investment or portfolio investments should generate over a certain period of time. In general, riskier assets or securities demand a higher expected return to compensate for the additional risk. Expected return is not a guarantee, but rather a prediction based on historical data and other relevant factors. Here are 4 key takeaways. 1. The expected return is the amount of profit or loss an investor can anticipate receiving on an investment. 2. An expected return is calculated by multiplying potential outcomes by the odds of them occurring and then totaling these results. 3. Expected returns cannot be guaranteed. 4. The expected return for a portfolio containing multiple investments is the weighted average of the expected return of each of the investments. Hope this would help. Thanks for watching.